And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Lauren Rich Fine, CFA and partner at Gries Financial Partners. Lauren, thank you very much for being here.
Thank you for having me.
So Lauren, I always like to begin. Can you tell us your story and how you got involved in this business?
I would be delighted. I was working at Merrill Lynch in their Treasury Department, and I'll spare you the story, but I was working for somebody there was no way I was going to continue working for. And I started networking, and people who had known me when I was in the Economics Research Department at Merrill Lynch told me I would be a great sell-side equity analyst. The first problem was I didn't know what that was. After they described it, I tried to understand why they thought I would be good at it. And they knew I'd gone through a credit training program at a bank and that I understood cash flow analysis. And they felt that I had the right personality for it because I love people, and they felt I would just handle that piece better than the average sell-sider. And there was an opportunity to work for either the head of the department doing strategy work for him or working directly for an analyst. And I went for the opportunity with the analyst. I thought it would be a great way to get trained. He ignored me for the first year. He felt that it wasn't worth taking time on. There wasn't enough on my brain for anything to stick.
Yeah.
But I came up to speed pretty quickly. I was at Merrill Lynch. I was working with the senior media analyst. And at that time, it was really everything from print to broadcast to cable to actually even cellular was at that time included in media. And he trained me. It was really exciting for me. I am pretty well balanced in all four quadrants of my brain. And so the fact that it was social, it was analytic, it was quantitative, I was writing a lot, I took to it immediately and really liked it. Within a couple of years, Merrill Lynch noticed that, and they gave me my own sector to cover in addition to supporting him. So I picked up the advertising marketing services sector. The man I worked for finally felt comfortable with me there and took a 2-week vacation. And when he came back, he said, wow, I just experienced life for the first time in over a decade. And he quit. So I got his job. I was a senior analyst now covering way too much. And we found a way to split the group. And so I covered all the print media in addition to advertising and marketing. But I went to them with a proposition that I should cover the internet because I knew that my ad agencies would benefit and I knew my newspapers would suffer. So I actually was Merrill Lynch's first internet analyst.
Oh,
it
wow.
was not the best chapter of my life. I'm glad most people don't remember it and that they think more about Henry Blodgett. That works well for me. But I did give up the group because at one point they realized I either needed to just cover that because it was growing so rapidly or give it up. And I chose to give it up. I had 2 young children at the time. Didn't want to spend most of my time out in California. But my reward was they came to me and asked if I would initiate coverage on the for-profit education sector, but train another analyst to take it from me. And so I did do that. And so I really had a really good 19-year career as a sell-side analyst. I was fortunate to be ranked number 1 II for 11 of those years. Really enjoyed it, but I wanted to change for a variety of reasons. And I should note that halfway through, they allowed me to move to my original home of Cleveland, Ohio. And so I spent half of my career working remotely, which only could have happened with the advent and commercialization of the internet. It was really fun to do it that way. I felt I was a better analyst because as I used to write quite frequently, I was living in the real world versus New York City and thought that I had a broader perspective as a result. But I enjoyed it. I wanted to change. I wanted to go out at the top. And so I left, and they gave me career retirement. It was, they knew I wouldn't go back into the field, or at least I didn't think I would. And I spent the next 5 years being a executive search consultant at a boutique search firm, mostly doing finance-related searches. I really enjoyed it, and it was lucrative, but I didn't feel intellectually challenged. And I decided I wanted to go and find an opportunity back related to the market because that had always been my happiest time. I loved the challenge of the market.
Right.
And I realized that I didn't want to go back to what I had done. I started meeting with some small registered investment advisors. Living in Cleveland, I knew there were a group of firms where they might be in play in terms of founders that were getting into their 70s looking for a succession plan. And one of the first meetings that I did was with Sally Gries, who had founded Gries Financial just over 40 years ago. She had been a longstanding client of mine when I was a sell-side analyst at Merrill Lynch, so I knew the firm, I knew the quality of the people. And that was at a time when they had been investing in individual equities. They shifted their strategy at one point, and so they were no longer doing that. But when I asked her if she could see me doing this, her eyes lit up. And unbeknownst to me, she had been implementing her succession plan and had the remaining 10% of the firm available for sale.
Oh, wow.
And that's what I did. I dove in. I bought 10% of the company.
Nice.
I became part of the leadership team. And then over the course of the next couple of years, I took over her clients as she gracefully exited the business.
Wow, that's fantastic. What a great story. So I guess the next question is, can you tell us a little about your investment strategy and how you play the game?
Yeah, so our firm, like many, really focus on asset allocation. And, it starts with really getting to know your client, in our case, high net worth individuals, small institutions, really understanding what their goals are. And again, when you're dealing with high net worth, our motto here is preserve and grow. And so we probably don't take as much risk as some other firms might, but our clients don't need to. They're really just trying to preserve for the next generation in many cases, almost like an endowment model. But we look at asset allocation, and then our research department has a series of different funds. So any of our clients who are in large cap growth would all have the same fund. It's the best idea.
Right.
The asset allocation is what would differ. But probably what distinguishes our firm and our investment strategy is we are huge proponents of the proliferation of private investments that have become available. And I don't mean just private equity, because actually we do relatively little in that area, although we do like it. We do a lot with either private debt. We've found a lot of renewable energy opportunities. The firm has always done a lot of direct real estate investing or into smaller funds that we know, and really opportunistic when we see interesting strategies that are taking advantage of some dislocation in the market. These investments are less liquid, but you tend to get compensated for that lack of liquidity. And as I like to characterize them, they have equity-like returns with fixed income attributes. And given the low returns in fixed income, that's very compelling for our client base.
Oh, that's fantastic. So do you take positions in companies like a venture capital firm, or do you buy established companies, or how does it work exactly?
No, we're buying in funds. We're not buying, except on the real estate side. There have been a couple of partnerships where we've been able to take a nice position with a broad range of our clients. But for the most part, it would be firms that we'd be investing in, like Kayne Anderson, who had a series of real estate debt funds that were really interesting. And Kayne Anderson is just really top-notch firm. And so going with a really good firm like that, where we have great access to them, there's a lot of transparency. We're a good client for them, so they treat us well. More things like that, where they're structured funds that we can put our clients into.
Nice, very nice. So I guess the next question is, how do you handle risk, Lauren, and what mistakes do you see people make with respect to risk management?
Well, that gets down to knowing your client, because, what I might see as risky might not look risky to somebody else. And so it's really understanding your client's appetite for risk and understanding what happens when you take risk. So there's no one strategy we employ. I mean, it really does come back to asset allocation and understanding your client's liquidity needs and how much risk they can take, making sure that if there is some type of catastrophic event, you still have enough liquidity on their behalf. And so I would say it's a constant balance that we take very seriously. But I'll go back and reiterate that since the motto of the firm is preserve and grow, we always tell people if we have to choose one of those two things, we're going for preserve. So I wouldn't say we take a lot of risk, yet somebody could look at me and say, but those private investments are inherently risky. I don't think they are. I think they have the same type of analysis and really transparency as other investments. And in some ways, I feel like they're less of a gamble than investing in the stock market. The market, has to me become riskier. Somebody who's a pretty seasoned investor. Back when I was a sell-side analyst, I could see with my own eyes the market was trading on fundamentals. I don't know that that's the case today, especially because at the latter part of my career, I was being trained in derivatives, because that's what hedge funds were employing as they were making their investments. And that no longer is an investment that's necessarily logical, that for all the research and analysis you can do, you might be right about the company and the industry and completely wrong on the stock. And so I would say that probably influences my attitude towards risk more than many other things. But I think it's people not understanding what they own. They hear that the market goes up and up and up, and they don't understand that there is still risk in the market. And so the mistakes that people make is just not understanding the volatility, the liquidity, and other attributes of the investments that they own. I think those are the biggest mistakes.
So just to make sure I understand you properly, the way you handle risk is by making sure that the overall portfolio is allocated properly to the client's risk appetite.
Yes.
And
making sure we educate them that they understand what they own.
Right.
Everything has risk. There's just different levels of risk. And certainly when we're putting portfolios together, we do the analysis to see how this combination of assets have historically worked together. But given that we're doing a lot of these private investments, we don't have, access to that type of historical data. And so it's really understanding and making sure we're investing with just really good quality firms. We look at the same things other people do. If there's been a change in portfolio manager and had they changed, the goal of the fund, but not told anybody, when you look at their ownership and go, wait, you're supposed to be avoiding those things, and suddenly they crept in. So we do the same due diligence that really anybody would do. And so I don't know that there's a way to avoid those types of risks, but it really comes down to asset allocation, good diversification, but more importantly than anything, understanding what you own and the attributes.
So I have a question, Lauren. You started off on the sell side as an analyst and you moved over to the buy side. At what point in time did you decide to leave the traditional equity fixed income allocation and move more towards the alternative space?
Well, we still do the traditional. I think what changed is we don't invest in individual securities. We do more funds. And it goes back to what I was saying. I don't think as a small regional firm, we have the same ability to see things ahead of other people in the market. And I feel like, my training was excellent, but the likelihood that I'm going to have an edge on an individual stock is ridiculous. And since we tend to buy and hold for long periods of time, it's easier to invest in funds where you believe in the portfolio managers, the firm they're with, and their analytic prowess. The alternative side has really been, for our firm, it used to really just be these real estate investments that we were a party to.
Right.
I would say it's been since we brought in our chief investment officer, when we had a change there, he brought with him access to a lot of these funds. And then I realized with my background and my network, I too had that. And then a third person. Our fund it's unusual. Our chief investment officer works remotely, and his background is Goldman Sachs proprietary trading desk, a couple of storied hedge funds, and then he had his own hedge fund. And the reason he came to work with us was he had promised his wife he would close his hedge fund at a certain age, that it was too demanding. He really is a great family man and wanted more time with his kids. And we offered him the opportunity to work remotely and help, with our portfolios. And it's worked great because he's got an amazing network. I've got the legacy of Merrill, and then we have another Goldman person who runs our Cincinnati office. And so between us, we really do get to see most of the really good deals out there. And we just find them intriguing because we feel like it's something that a lot of other firms don't offer, don't have access to. But importantly, I think we all feel like our backgrounds are the type that, we feel like we do have an edge on these. We can see what the good ones are and which ones we would take a pass on.
Understood. That makes perfect sense. So I guess the next question I have for you, Lauren, is what are some timeless lessons that you've learned along the way that you'd like to share today?
I don't think I have anything profound to say here. I think it's not selling too soon and holding on and sticking, by your guns. We all know the biggest mistake people make is selling and forgetting to get back in and buy again.
Mm-hmm.
And, I guess the more seasoned I get, which is a fancy way of saying the older I get,
right.
You start to buy into the longevity of the market and that it does work over time, and making short-term moves sometimes can work against you. I've had periods of my time where I was able to trade in and out of things, but that just, for me, only worked in short periods of time. But the buy and hold, to me, is the timeless lesson that if you have the right asset allocation, for the most part, that works.
Yeah, that's great. It's a really, really good point. And then what are some timeless mistakes? I'm assuming they trade often, but I'd like to ask the question anyway, outside of just over trading or not looking at the longer term time frame, are there any other timeless mistakes that you see people make with respect to their money or their investments, and how to avoid them?
Yeah, it's going to be an odd one given the position I have, but I think sometimes people trust the wrong people.
That's a good point.
And they make decisions based on their perception of the cost. We're a fee-only firm. We're very transparent. And we can prove time and time again the value of the advice that we give, because we also do wealth management in addition to just the investment side. And the type of analysis we can do on behalf of our clients is exceptional in terms of helping them figure out their needs, how much they're spending, et cetera. But sometimes they look at our fee structure and like, well, these guys are cheaper, I'm going to go with them. A couple of years later, they call and they go, okay, that didn't go so well.
Yeah.
I guess you get what you pay for, but it's also doing the right research on the advisors that you choose. If you can't get good referrals, good word of mouth, good recommendations, I think that's a mistake that people make. And, we're fortunate we're on the receiving end of those bad relationships, but you hate to see people get burned like that.
So what advice would you have to people as far as doing their due diligence when they hire advisors or seek other managers to avoid those pitfalls? Is it just not look at the price, the fee, and that the advisor charges? Or are there any other
I
things?
think you should look at the price.
Yeah.
It's just really understanding, first of all, how they're charging you, what services you're actually getting.
Okay.
But importantly, talk to other people that have used the advisor. Make sure they're available to you. Make sure that you're really getting the person sitting in front of you, pitching you. Go and visit the firm, walk around, see if you like the culture, the fit. It's a big decision. Take your time making that decision. But, get them to give you some references. We have some very happy clients that are very happy. I mean, we're very confidential. We don't walk around and talk about who our clients are, but we can figure out who the right client is to use as a reference for a prospect. But it's important that they understand how you work and that it's the way they want to work.
Understood.
I had somebody come in and they had all individual equities, and I kept stressing to them that isn't what we do. Are they sure they understood what we did? And it was a difficult first year. We've won them over with what we're doing. But it's interesting that people don't sometimes hear what's being said to them also. But just being patient and not rushing to make a decision, not chasing performance per se, but chasing the overall relationship and the long-term planning, management, and the investment returns.
I love that point about saying something and then having the other person receive it. I learned that lesson years ago with my wife, where I would say certain things and it wasn't received that way, and vice versa.
There's a book about that. Men are from wherever and women are from Mars.
Yeah, Mars and Venus or whatever it is, right? But it's with the client.
But it's interesting.
Yeah.
It's some people listen better than others and really hear what's being said. And I've been taught many times to try to do that sanity check to say, "Are you sure you understood what I said? Can you tell me what you thought you heard me say?"
Yeah, that's brilliant. Having them actually recite back to you is really the key part of the whole equation that I've learned, at least. But yeah, that's a really good piece of advice.
I learned that with my children,
yeah,
too.
Exactly. I was about to say, Sherry, it's not just the wife, it's the kids as well and everybody else. I never thought of it from the advisor to the prospect and client relationship, even though I've experienced it myself and heard countless others. So the fact that you bring that up is a really good point.
It works for me.
Yes, I love that. Okay, so next question. What is the best piece of advice you like to share?
It's funny. It actually would relate to what we were just talking about. Stop talking and listen.
Nice. Very powerful.
It's it's interesting when my mom was a psychologist. She went back to school when I was growing up, so we can't blame any of my idiosyncrasies on her because it was late in life that she became a psychologist. But she was paid to listen a lot, and it's just something that she really instilled in our whole family. And even when we were going out and interviewing for different jobs, it's so amazing that the best interview is one where you actually listen versus talking about yourself.
So true. So true. It's
So,
I love that. It's actually
and it works well in this business too. So,
it really does in all aspects of life, and that's kind of what I do here on the podcast. I just ask a question and I listen intently. So I love what you just said. That's really, really fantastic. Lauren, is there anything that I didn't ask that you'd like to share before we wrap up today?
the one thing, and it's very different than what we were talking about, but I'm struck by the fact that there is still a big male-female divide in terms of who isn't intimidated by the market and who is drawn to the market.
Mm-hmm.
And I'm a big fan of trying to educate everybody on financial literacy. I do some work at some of the high schools in town trying to make sure they're getting kids at an age before they're launched into college, et cetera, having these financial literacy. But women in particular, all couples allocate certain responsibilities to one person or the other, but financial literacy is important for both parties. And so programs like you're doing where you're just trying to educate people are really important so that people are comfortable and understand their advisors are just people and they can rely on them and they can trust them as long as they have the right one.
Right.
But trying to take the time to be educated, it's really important.
Yeah, I love that. My mom was a teacher, and my whole thing learning, I started from scratch, nothing, and I've spent my whole career, and I'm still learning, just a labor of love. I really love to learn, and hence, one of the reasons I set up this whole podcast was just to learn, as well as share that education with whoever wants to listen. So I really, really appreciate it and value what you say.
Well, I always need to be learning new things or I don't feel challenged, and that's why I left being an executive search consultant to go back into the market, because the market does teach you a new lesson pretty much every day.
Oh, yes, it does. Yes, it does. That's actually fantastic. Well, Lauren, thank you very much for being on the show. Before we go, what is the best way for people to get in touch with you?
Email is always the best because my phone travels with me everywhere, and it's LRF for Lauren Rich Fine at Gries.com, which is Gries as in Sam, Gries.com.
So LRF at Gries.com, Gries.com.
Correct.
Perfect. Well,
and I'm very receptive to email and usually get back to people pretty quickly.
Beautiful. Thank you very much for coming on the show, Lauren. It was a pleasure, and hopefully we'll speak again soon.
Great, and thanks for having me. Have a great Thanksgiving.
You too.